Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, you're just curious, you just like following the multifamily industry and real estate investing, well, luckily for you, you're in the right spot. Because here at the Gray Report, every single week, we are breaking down all the latest data, research, all the opinions, whoever's got a crystal ball revolving the multifamily industry, real estate, and the economy. All this to really help us, but especially you, make some really good investing decisions going forward. A lot of uncertainty out there, a lot of things to figure out. We would hate for anyone to make any mistakes. So that's what we're doing every single week on the Gray Report. We got a great set of new articles and reports from the Bureau of Economic Analysis, Fannie Mae, wealthmanagement.com, Globe Street, CoStar. Matt's got some great things to talk about. Also, strap in, got a great episode. Let's get into it. All right, bringing it back. Welcome again back to the Gray Report. I hope you're having a great day, great week. Matt Bosnagel, Director of Communications and Marketing, back on the Gray Report, as he is every week, all the time, co-hosting the show, making it work. Matt, very impressive set of intelligence you got in front of us.
Yeah,
today.
this was this week may have been some of the most interesting stuff that I've read. Not all amazingly great news, but like we said a couple weeks ago, in a normal year you still have to work. So
yeah, well, and we want to dish to everybody straight too.
Yeah.
Definitely not the show for rose tinted glasses and hey, rah, let's all just go do something because maybe we were in the business of doing it. We're putting our own money in these deals, so it's just as important to us than anything to kind of get this right. When to zig, when to zag, and when to get in the foxhole.
Yep, exactly.
So, but Matt, I'm excited because we got a couple other episodes coming out. So make sure you're subscribed to the Gray Capital YouTube channel. You're getting the podcast because we had, so far, just this week, we had Carl Whitaker from RealPage. We also had Paul Fiorilla from Yardi Matrix, U.S. Director of Research. These are the guys that are getting all the input. Between RealPage and Yardi, they're literally, we're talking tens of millions of apartment units of the data they're getting. The most data inputs, some of the best analysis in the market, and we kind of got the two guys that are right in the middle of it, and be able to get their insights of what they're seeing. So make sure you catch those episodes and you go to the YouTube channel because they're going to be coming out any day now. Mm-hmm, so really exciting stuff. Go kind of straight to the horse's mouth. But Matt, let's just get right into some of these reports.
Yep.
The first one is from the Bureau of Economic Analysis. We had a GD print this morning, and so we're going to be starting macro, but it's important. And I was making up an analogy, Matt, kind of just before we started recording of it's like the economy. It's like we're in a car, and we skidded on something. We're going too fast. We just put the foot on the accelerator and whipsaw one way, and then we were whipsawing back the other way. And it's almost like we're just kind of like laying right in the middle, back to normal.
Yeah.
Which is hard to believe, but I'm seeing a lot of outlooks and predictions or metrics that seem very normal. I'm seeing 3% projected rent growth, a national rent growth for 2023 that RealPage is predicting as well, or sorry, that Yardi Matrix is predicting, and we've got a GDP print that looks relatively normal, and the stock market is excited to see it. The stocks are up at least today. Tomorrow's going to be a different story, but again, I think returning to normal is the theme.
Yeah, I think that, and this kind of gets into a little bit about people's sentiments, but, along with the recession kind of programming people to really think not so great things about the economy. For 10 years, we've been pessimistic, and it's hard to get optimistic again. But also, I think for seeing technology, the technology sector, which was such a huge engine of jobs, and hearing all these headlines about layoffs, certainly probably plays a little bit into people's perception of where the economy's going. You don't really hear about, even when it's good, you don't hear a lot about like civil engineering jobs or anything like the tech sector specifically.
No, so far, it's been pretty isolated to the tech sector, not like completely, but mostly pretty well isolated. And not that there's not the recipe out there for some like really bad economic times.
Yeah.
Like there's absolutely the recipe out there. But as we were talking about earlier, you can usually always connect the dots and find a way where we can get to a recession pretty quick.
Yeah.
But it's almost like we feel like we need to feel some pain. Like we have to repent from all of the excess growth of 2021. And, we're due. And partially that is true because we should see a correction and if things go up, things can go down to, find the mean. But, but that doesn't necessarily mean there's going to be as much pain as some people are predicting. That being said, there's gonna be some bumps. There's gonna be foreclosures. There's gonna people who have deals blow up. Like that's going to happen because something that we've been focusing out here at Great Capital. I've talked a lot about to the team a lot the past couple of days because we had Q4 obviously ended at the end of the month, so we're getting all of our Q4 reports finalized. It's a lot of work. We put a lot of effort into putting these reports together, and so it's another time to just look at the portfolio and plan. Yeah. And I said, this is the next couple of years, maybe this next decade. Like we are not going to have the luxury of just cap rate compression and appreciation, and you could just. The rents are growing without doing anything, and the prices are growing without doing anything. And you could be there. There's a lot of great operators, but you could have been pardon the lack of a better term, but just a piss poor operator the past couple of years and still made bank. You could have just run your property into the ground, mismanaged it, and still could make a really nice profit just because everything was appreciating. That's not no longer the case. I mean. It's all going to be about operations. It's all going to be about controlling expenses. It's all going to be about finding, your edge and being competitive in the market and the right renovations.
And maybe not necessarily because it's going to be a horrible year, but because that's just the work of.
That's just the work, and that's how it's supposed to be.
Yeah.
And like that's the thing. Like the last 10 years, for a while you had to do that work. You had in order to force appreciation, to move your value, you had to do the work in the marketing and making sure that the your renovations that you were doing aligned with what is in demand and you was priced right. You could do it at the right cost. But for the past 3 or 4 years, what was happening is people were saying, "Yeah, I'm going to execute this business plan," but then they were getting the rents without doing the work, and so they're like, "We're just going to let it ride." And then a year later, they're like, "Hey, we can sell it and make a 2x to our investors without doing anything and do it again."
Yeah,
sure. But like, there's no really skill involved other than putting the deal together, which is a lot of work and complicated. And putting the deal together is different from doing the work. And so people are gonna have to put the work in, and I don't know if everyone's up to it.
Yeah.
And so people are gonna have to bring some money to deals. I mean, if you have a bridge loan that's expiring, I mean, just looking at where the values have dropped, and Paul actually had done a piece on this and some analysis of just where cap rates have increased to, and the decrease in valuations of if you're trying to then refinance into a new loan. You're going to have to bring, like on a $10 million deal, you may have to bring a couple $1 million to the table. Yeah. It's like basically doing a new raise for the deal. Going back to your investors and say, "Hey, I know you put in $100,000 in. We haven't done that great of a job, but if we want to keep this deal and you don't want to lose your money, you're going to have to pony up for another $100K."
This is people with floating rate loans, you mean?
Well, it could be anyone that could be underwater that has a loan coming due. Now, if you bought the property and you had a long term, you bought the property 5 years ago, you're probably in a good shape because you've experienced all that rent growth in the time, and it may be appreciated 50%, and then it's gone down 20%, but you're still up. So you're still up quite a bit, and so you still have some spread there to refinance potentially at a higher interest rate. But if you bought something for $10 million and you had a $7 million loan, but now it's worth $7 million, which was the balance of your loan, and your new loan is only going to be $4 or $5 million. You got to bring like $3 million, $3 million to the table to even close to roll the debt. No cash out. You have to bring cash to the table, and some groups that are well capitalized will be able to do that. Some may be able to sell and squeak by at a small profit. Some people will lose.
Yeah.
Some people are going to lose their money, and that is unfortunate. But I don't believe that it's going to be systemic and affect the whole industry. There's gonna be some pain, but I know more people that are set up in the right way that aren't going to have those issues than not. But I also know a good amount of folks that have been doing deals that I'm worried about.
Yeah.
So
I think the attention to operations, I think may be one of these really key differentiators between success and failure.
Absolutely. So as we sort of digress, I mean, we're talking about multifamily, but let's get into the macro. GDP, Matt, what's going on?
Okay, so GDP increased at an annual rate of 2.9% in the fourth quarter of 2022. For the year, GDP increased 2.1%, which if you can see this graph that we have, the fourth and the third quarter of 2022 made up for the slightly negative growth that we saw in Q1 and Q2 of 2022.
And that was not that was like technical stuff, right?
Yeah. Well, that's the one that we're not supposed to call it a recession because the committee didn't tell us. So technically it wasn't. But seeing 2 consecutive quarters of positive GDP growth is certainly it's not a bad place. It's not so bad. Now, again, for the year it was 2.1%, but annualized, the quarterly GDP was 2.9%, and that's pretty close to I think the average is around 3%, 3.13 or something like that. But that's typical.
Usually in the 2 to 3% range. I mean, in GDP and inflation are historically have kind of been relatively close and correlated.
So all things considered, I think we're not in a bad place. But I'm like we were talking about before, I'm really looking for kind of the upshot to this news because it's not exactly it's not horrible enough to make us really run for the foxhole.
No, I mean we've got some good GDP growth. I mean that's usually take everything else. That's a good sign for the economy.
Yeah. And it's not too high where you'd start getting scared of start having nightmares of Jerome Powell.
We talked about Three Little Bears there. We go
yeah, exactly.
I mean,
I was thinking about this too. The thing about a soft landing is you don't know if you landed yet.
That's true. That's a really good point, Matt. You got a good enough pilot, and it's just smooth and.
But yeah, I did do a little bit of thinking about the implications really then for the economy. So what can we expect maybe for the economy? And then what about the multifamily market?
Yeah.
Well, residential fixed spending decreased, which shows that increasing mortgage rates have had a material impact on this slice of economic growth. In Q4 of 2022. And you can see that play out in the numbers for Q2 and Q3 as well. Residential spending was negative 17.8 in Q2, negative 27.1 in Q3, and then negative 26.7 in Q4, which lines up really well with the timing of the interest rate hikes that we saw last year. Consumer spending growth shrank a little bit from 2.3% in Q3 to 2.1% in Q4. If you want to read this as a sign of decreasing consumer sentiment due to fears of a looming recession, you are certainly welcome to. But again, if you're thinking about interest rates and what's going to motivate the Federal Reserve, that may not be such a bad thing to have consumer sentiment slightly down, not catastrophically down. And actually, in one of their releases that breaks down, at least it's the accompanying publications, the Bureau of Economic Analysis compares 2 different price measurements, the Gross Domestic Purchases Price Index and the Personal Consumption Expenditure Price Index. And no matter how you slice it, and they have core versions of both of those, no matter how you slice it, price growth is going down. Inflation, at least as indicated by these metrics, is going down. So, aside from the stark decrease in residential spending, the numbers for Q4 GDP, like I kind of said, they aren't really dramatic enough, at least for me, to get a strong answer. You're not getting anything clear. You may have to kind of track back and see where the trends are going. And I really think people are still worried. Obviously, they're still worried about where interest rates are going to go and what kind of signal does this get. And the only thing that I saw as a clear unequivocal trend was the decline in residential investment. And actually, back to that residential spending as a clear indicator, a new post on Bill McBride's Calculated Risk blog suggests that we may be heading for a recession because residential investment is typically a leading economic indicator. It's a valid conclusion, I think, to expect a downturn if we're going by the typical pattern. And he has a graph here that shows, you can see, it says residential investment it typically leads, and then that's followed by, I think that is followed by non-residential, and then by equipment and software. You can see, the red line goes down, which is the residential, and then the green line, which is equipment and software, and then non-residential after that. I may be getting some of this mixed up because, for one, I don't think it's a perfect pattern, and for two, I'm not really sure if the typical pattern applies to our current situation.
Yeah.
McBride himself even notes that the sudden economic stop due to COVID-19 means that the usual pattern didn't apply in the recession a couple years ago. And I also think that currently that we're kind of seeing the ripple effects of these abnormal conditions, and I think that there is a good chance that we may be operating, we may have an outlier, kind of an atypical condition.
Yeah. And just, what kind of outlier, is it a positive or negative? I think that's the question. And then there's certainly some black swans. I mean, one thing, that's still, that just still obviously present and floating out there is, the war in Ukraine. And, I think if things stayed the same, or if there was some kind of ceasefire, or things slowed down, I think be continuing a normalization. On the other hand, if things continue to escalate, and we get and because in many ways, and not to talk about get into geopolitics much, but like it more and more it's like a really like a NATO versus Russia conflict.
Yeah.
And like the West versus Russia, and so I don't believe that this is going to happen. But if there was a major escalation, and like Russia attacked Poland or something, or Germany's given them the Leopard tanks.
Yeah. There's
some kind of escalation, because it is kind of we are kind of like we are doing it.
Yeah.
And that's something that I think that would really, all of a sudden we could definitely have a recession just based on that type of uncertainty and fear. I think would really plunge us down.
Yeah.
But for how long, I don't know. But so there's other stuff out there.
No, I agree. So that's, I think that this GDP print just came out. There's probably going to be some continued analysis of it that I'm going to be following up on. But outside of the quite obvious, I think, impacts of increasing interest rates on the residential side, there wasn't anything that really changed the uncertain morass that we're in right now.
And interest rates, interest rates right now are they're obviously higher than they were a couple of years ago, but like right now borrowing rates, kind of in the fives, like low 5%, like that's pretty darn normal, like historically. And so, and I heard someone say this on a call recently, someone who's been doing this for decades, and they're like, I remember when interest rates were 5, 6, 7%, and we were all doing deals. We were able to get deals done somehow. Yeah. So maybe it's gonna look different than it did a couple of years ago, but like we're still gonna be able to do deals. Now I don't know if it's gonna. I don't think it's gonna look like it's the 80s either, but again, it's kind of more normal economic conditions until we get ourselves into the next. Whatever.
I'm waiting, and that's kind of the theme of the next two articles. That it's like people are waiting, kind of waiting for a big signal economically, waiting for a big signal in terms of where housing demand and an apartment demand is going to go, and waiting for a big signal. And I don't know if you're ready to transition to the next. Waiting for a signal on the acquisition side from buyers and sellers on. What's going to move the markets? We're at this we're skidding our wheel. We're ready to just make that lurch. And once we get going, the idea is there will be an anchor point and a frame of reference that people can kind of use, and then things will start to.
Yeah, I think one of the big turnaround is when we have confirmation that there will be at least no additional rate hikes, and that the Fed funds rate is going to hold. And I think that we're nearing that time, because I don't think very many people at all are predicting many more rate increases. It's maybe 2 or 3 more 25 basis point, maybe one more 25 basis point increase to the Fed funds rate. But then we're kind of done. We're going to leave it there. But that allows all of a sudden deals to get done. Maybe the prices still need to come down to make sense. But again, if interest rates are in the 5%, I'm seeing cap rates now, up from their 4s. Now they're in the 5s. It was what was a 4.25 last year is now maybe a 5 and 5.25. So we're seeing 100 basis points of cap rate expansion that we've called for since relatively early spring last year. So there needs to be a little bit more spread. There needs to be a little bit more meat on the bone to keep people really excited. But like we're getting closer and closer, I think, and then it's just who's going to really start getting into it first. And then I think it's the floodgates are going to be open for our acquisitions, because, I keep hearing, this is from investors, from everybody being like, no, I want to get into more multifamily. I'm just trying to find the right entry point right now. But that was where I'm allocating to. We had an investor, Matt, this was a week ago or so. He was at a big banking conference, and he talked to an executive of a very large national bank, and he was like, and they're basically saying how they're very cautious, and they're like, we're not really doing a lot right now. And investor of ours went up to him and he was like, so, okay, I know you got to say they got to be conservative, but what are you doing personally? What are you looking to do in 2023?
Yeah.
And he had one thing that he was confident about. Yeah. And he's like, I'm going to be investing in buying multifamily properties. And this is a guy that could have, any asset class. He's not a real estate guy, but that's complete anecdote. Yeah. But it's the idea that there is, it doesn't mean that he's right or we're right, but it means that there will be the buyers there when things are a little bit more predictable. But we still don't have, on average, the appropriate return and risk premium on most of the acquisition opportunities we're seeing to go forward. Yeah. So it's like we're getting closer. Now, like the deal, like Echo Park, the property down in Bloomington that's only open to accredited investors, that we're going to be closing on, here soon. We got some new financials, and it's like the risk premium is totally there. We're out of the gate, 7% cash on cash, and we're buying it. It's not a the cap rate isn't super high. It's still just barely sub 5, but the interest rate's 3.4%. So the spread's there, the cash flow's there, but even the cap rate is a little bit lower than I would like. The basis is awesome for a new construction. So so there are opportunities out there right now. These suitable deals are the only ones that are really getting done. Next are going to be some of those distressed opportunities, foreclosures. And then all of a sudden, I think because still no one who doesn't need to sell is really bringing much out on the market right now. Unless it's interesting, I know we're going off on a couple different tangents, but we're getting approached more and more directly from sellers, coming to us. They're not going to brokers necessarily. They're coming straight to us, and they're like, hey, we want to we've been wanting to sell this thing. We want to explore it with you, but we're just going to bring it direct to you guys because we know you guys are in the market, and we know you guys been buying in the past, and you get whatever we've got a decent reputation to get things done, and so we've gotten a lot of just deal flows that's coming to us directly because people have heard that we're doing deals, and that we've executed on good deals in the last year or so when a lot of people else could not perform.
Yeah, they say a lot about, it's becoming, is it a buyer's market or a seller's market? I think that it's still, because there have been a lot of deal activity, it's still a little bit of a seller's market.
Yeah, it is. It all depends on who the seller is. If the seller doesn't have to sell, then the seller's look, no. People approach us to buy our properties all the time, and properties that we don't necessarily want to sell, and we're like, look, you got to really motivate us. I'm going to give you a number, and it's not going to be a reasonable number because we don't really want to sell it. But if you'll pay this price, let's talk. But it's the people who have to do something, who have that loan coming due, or who have a big big bill that they have to pay.
Yeah.
They've got whatever it is. They're like, I got to make something happen. Like, I just got to get out of this. And some people are gonna throw their hands up and walk away, hand somebody else the keys.
Yeah. Well,
I'll take the keys.
And that's what, and that's and the odds of that is what these next two articles are about. And I can jump into this first one.
Yeah, we got wealth management piece. I don't know. The formatting's all kind of weird on the browser, but I think people can get past that.
So this one, it says, the title is 2023 is unlikely to bring a large wave of CRE distress, and it is a conversation with the chief investment officer of Walker & Dunlop. His name is Marcus Dooley, and this is, it's a lot of the stuff that we've been talking about, a lot of things, that we have noticed ourselves among our investors. They're kind of noticing, they're kind of plugged into how much distress is there, how many people are kind of in an unfortunate situation when it comes to when it comes to floating rate loans. My question is, how much will this situation characterize the market, and more generally, what can we expect in terms of sales activity in 2023? And Marcus Dooley does not think that distressed properties will be a major factor in the CRE markets. And I think he sagely notes, he says, we're going through conference season, and as people transact because they have to transact, they will set the market. It will be comps for appraisers, and we're seeing it now. So a lot of this uncertainty could dissipate following the discussions and negotiations at conferences like NMHC, which is, you're headed there. It's the multifamily specific conference headed next week in Las Vegas.
Reporting live next week, man.
Oh, good.
From NMHC, by the way.
All right,
I'm bringing. I need to talk to. We're going to bring a mic and some gear, because we're not only going to do the great report with live. I've got some other report videos to do for like properties, but maybe live on the floor.
All right, awesome. Perfect.
I don't know. Continue.
And Julius is quite clear-eyed about the perspective of buyers in the situation. Yes, the title is that it's unlikely to bring CRE distress, but he's makes some pretty forceful points from that perspective of a buyer. He says that buyers won't buy at prices where they will not hit their targeted returns. Ultimately, what will happen, and what has happened, is cap rates are adjusting. As an investor, I cannot buy a property and take a lower return. I think that really cuts through a lot of the uncertainty there. With with significant implications, I think, that put some force behind Dooley's statement. As we've noted before, these buyers and investors have specific return criteria. If the math doesn't work, they're not going to be able to buy. That's kind of the buyer's side. And if I'm the seller, I'm thinking, well, what if this return criteria is unreasonable? Can't these cheapskate buyers just lower their return threshold? And I think that the implication from Dooley's statement is that actually these buyers do have reasonable return criteria, and sellers are going to have to accept lower property values and higher prices. I think that part of the force that I'm putting on Dooley's words here is me calling to mind the perspective of a seller who's reading some of the projections that property valuations could go down 20 to 30% this year, or they already are down significantly. And even though they might have seen a 40% increase in the past 3 years, it's really hard to give up that last 20. Even if their net is 20% extra, they feel like someone's reaching inside their wallet and taking that 20% away. Yeah, and they want all that 40.
Yeah, especially they've told their investors.
Yeah, exactly. And I remember, as a home buyer, there was something that there was in part of negotiations, there was something that we were going to try to get a little bit cheaper of the house. And I was like, the way they see it is not going to be like this theoretical price is going down. They're going to see it as us taking money from them. Yeah. Oh, yeah. And so it really hurts to, I think that right now it hurts to think that for sellers, and the pain's got to go the other way. They've got to start to rationalize these losses, and nothing's easier to do that than simple math. But sometimes math isn't so simple. So
that's true. And so this comes from Walker Dunlop, or Marcus Dooley is works for Walker Dunlop, and Walker Dunlop is they're in the business of originating loans. They're they have a variety of commercial real estate services, from investment services to capital markets, a lot of different stuff. And so obviously they want the multifamily market to do well, but they're usually pretty straight shooters. Yeah. So, we work with Walker and Dunlop pretty closely. But one thing that I asked Paul Fiorella this as well about this exact question of loans coming due, and what I was wondering is, how accommodating are banks going to be? And how willing are banks and lenders going to be with borrowers who are in these situations? Because, banks don't, as much as like, I'll take the keys, banks don't want the keys. They don't want to manage properties. They learned that back in 2008 during the great financial crisis. We saw in the pandemic, there's a kind of a precedent now for, kind of being nice and easy and like, oh, it's a hard time. We had forbearance. We had all kinds of forgiveness and eviction moratoriums and things like that. Now we don't have those exact things going on just yet, but this idea of intervention, whether that is private intervention from the lenders themselves, being like, hey, look, we're just going to work with you. And I think most will want to if there's good faith efforts being made by the owners. If not, then that's a different story. Then also from the federal government, FHA, Fannie Mae, Freddie Mac, HUD, they're doing, about, I think, over 50% of all the loans in the multifamily industry. They may even get some, straight up mandates.
And Marcus Dooley notes some of that stuff that he said too, is like, there is going to be opportunity for people to recapitalize, and selling is going to be a little bit of a last resort for a lot of people. So there's a lot of options, and selling it to a hungry buyer is just one of them.
Yeah, there's going to be some pretty high yielding mezz debt, I think, that's out there. People are going to put some additional debt on these properties. That's going to be in a second, subordinate position to the first loan, but like they're going to be charging some pretty rich interest, and so I think there's going to be a lot of investors for that. Paul also mentioned that. And Marcus is also mentioning that there's going to be a lot of pref equity in general has come into vogue the past 8 months or so, because with LTVs getting squeezed and harder to get their cash flows, buyers are bringing on some pref equity to juice the common equity and fill up the capital stack. And so, if that example we talked about earlier of, hey, I need to bring $3 million extra dollars to the closing table. Maybe they can get some pref equity that fills that spot. Maybe it's a JV equity that completely recapitalizes the deal at some very aggressive terms, or maybe they can get some mezz debt if the first position lender is good with that.
So there are options. So this is the kind of, and I do seem to think this seems like the realistic option. Now, it's not the only view of next year in terms of property sales and distressed property sales specifically, because there's this article from Globe Street that says a lot more likely. It says that expiring interest rate caps are going to fuel distressed property sales, and in the Globe Street article, I think it's a pretty good counterpoint actually to the article to the comments from Marcus Dooley. I'm really highlighting rather than downplaying this possibility. And as support for this claim, the Globe Street author writes that in 2019, the Mortgage Bankers Association estimated that up to 1/3 of all commercial property debt was floating rate, with most lenders requiring that borrowers hedge against an increase in the borrowing costs. 2019 conditions are certainly different from the last 3 years, but you could make a case that the ratio of floating rate debt increased during the pandemic. Sure, it could have decreased. Even if it's the same, that's a pretty big chunk. 30%. What does it say? A third of all. So that's a lot.
Yeah, that was in 2019.
Yeah,
and now there's more in multifamily because of FHA and the agencies. There's more fixed rate available in multifamily than other commercial rate asset classes. However, there's always been a lot of floating debt, and man, in the pandemic, there was so much bridge debt, and there was people were saying, I remember all the time people saying they're like, our interest rates aren't going up anytime soon. It didn't seem like they were. It was like free money for everyone forever, and so a lot of people were saying, hey, we'll figure it out. There's so much rent growth. Like, hey, we're locking in, and because your rate would be so low if you took some of those floating rate loans. And when the interest rate caps were cheap back in prior to March of 2022, it was a great deal. You'd be able to buy a cap that you could afford. You'd have a rate in the 2s, a bunch of interest only. Like, sounds like a deal. And one of the reasons is because the prepayments are much more flexible in the floating rate. You can get out early without a big prepayment penalty. Where on fixed rate loans, a lot of times there's a steep prepayment penalty that can make selling it early not attractive. But like a lot of these floating rate loans, it's like a 1% prepayment penalty after a certain time. And if that's the case, then you have more flexibility. You can sell it in the next year or two, because what a lot of owners experienced during 2021 and early 2022 is that they had an asset that was very valuable. It had appreciated considerably, but the prepayment penalty was so high they couldn't do anything. They couldn't refinance. Okay. They couldn't really sell it. I mean, they could, but a lot of their profits were being eaten up by these prepayments. I mean, it could be 10% prepayment penalty.
Yeah.
It can be steep, and so they're like, maybe we'll do it, but maybe we'll wait. And so a lot of people were like, there's too much risk in the inflexibility of the prepayment penalty. I'll float it because then in a year or 2 years, if it bumps up in value again, I can flip out. I can get a 50% IRR, give a 1.75 or 2x to my investors, do it again, and just keep rocking and rolling. But the music's kind of got slowed down, if not stopped, so that doesn't really work anymore. We switched pretty early. I mean, we historically haven't done a bunch of floating rate debt. We've done some bridge loans for a lot of value add stuff. But yeah, we started shifting away from that March last year because we just knew it was what was up.
So it's either going to be a flood of distressed properties entering the market, or maybe more of a trickle.
The flood of distressed properties makes for a better headline.
Yeah, it is true. So I'd rather be making that thumbnail of an impending flood.
And it's going to be somewhere between. There will be distressed properties. People are going to lose their shirt, but it's not everybody.
Yeah.
In fact, I think it's going to be the exception that does rather than the rule, because it's not like everyone had a bridge loan.
Yeah.
It's not like every property. It's not like every property was sold last year.
Yeah.
Or the last couple of years. And then some of the properties that were put on a bridge loan, they're going to be okay. I mean, we have one property that has a bridge loan on it because we were doing a big value add. We've gone through the value add. We've gotten rents up. It's so NOI has increased quite a bit, and even our net cash flow has. But our debt service, when we started, we were paying about, when we had a floor. So if there wasn't a floor, we'd be paying like $10,000 a month, but we were paying about $21,000 per month in interest.
Okay.
Now paying, I think, $59,000 a month in interest.
Yeah.
But our NOI went from being in the went from being kind of in the low 50s and 60s K per month. Now we're in like the 90s per month. So we've grown rents and we're in a good spot. And we also have we have so much reserves that we brought on for not only capital expenses but for stuff like this that even if we had to bring cash to the table, we could. But we're not going to have to. Yeah. But there are some folks that don't have an extra couple million sitting here ready to go, or they were unsuccessful at their business plan.
Yeah. And
they're looking at low NOIs. They're looking at increased debt service that has literally doubled, almost tripled. And that's rough sailing.
It's going to be some important conversations that happen in the next 2 weeks, really. So this is a particularly exciting time.
And like I said, it's conference season. NMHC next week in Las Vegas is going to be. It's going to be. I'm hoping to have some insights to report back to Great Report.
I didn't notice this last year. It wasn't. Yes, there was it's typically the start of the deal season, within, but it was much more there's MHE.
Everyone's waiting. Last year it was everyone's waiting to launch the deal. It's usually there's a slowdown in deal flow because all the brokers want to go to NMHC and to launch their deals.
Yeah.
And we would get some previews and stuff, but all the deals get launched at NMHC. Now it's everyone's is going to. I mean. They're going there to see what's going on, and maintain the relationships and have the conversations. But I've heard rumors that where some brokers would be bringing out dozen plus properties, and it's going to be a couple. Yeah, well, but it's there's only going to be so much in the market, so if someone really wants to buy, there's only going to be so much inventory out there. But are there going to be takers for that inventory at that price? There's a bidding war over just the scraps.
Yeah.
But it'll be. I mean, last year last year, everyone was making so much money they didn't know what to do. And the brokers, they're just crushing volume. The lenders are originating loans. The buyers are not doing. The operators not even doing anything. They're making money. They're refinancing. They're selling their deals for stupid cap rates. And everyone's thinking that they're so smart. And now this year, everyone is like going to show up scratching their head.
Yeah.
And so it's going to be interesting. It's a little bit of groupthink, obviously, when in those types of situations, because everybody wants things to work out all right, but also everyone wants to come off as the most conservative and whatever. But we'll have some good insights to report back.
Yeah, it's going to be crazy.
Well, Matt, we've talked a lot about the agencies. We mentioned them, Fannie Mae, Freddie Mac. Fannie Mae has got their multifamily economic and market commentary for January 2023.
Yeah.
Spill the beans. What's going on?
Yeah. So Fannie Mae does release their like multifamily commentary every month, and sometimes they just talk about like a tiny slice of the market, and like it's like a student housing one month or senior housing the other month. But this was a really good one, and it was longer than usual. It gave their outlook for 2023, and it's a little bit of a doozy.
Which for context, the Fannie Mae and Freddie Mac usually their outlooks are often a little bit more conservative.
Okay.
Than,
well, that makes me breathe a little easier, but it's still.
Well, I'll have to send you an episode of the Great Report from last year.
Yeah. Maybe I'll have to look back and see what they said.
Their rent growth projections, and sorry, I don't have that actual from last year, but their rent growth projections were like a fraction of like all the other producers out there. A lot of people were calling for like 11% rent growth. I think for their last year, we ended up having 7, and they were like 4 or 3.
Okay,
Which they may have been close, kind of in the middle. So they still weren't right, but much more conservative.
Yeah,
so
it's definitely. So their expected rent growth for 2023 is 1.5. This is not the 3.1% that we heard from Yardi Matrix or from other sources. This is definitely not really close to that. They think that vacancy will increase to 6% in 2023. And as far as absorption, it's expected to start out negative but end the year at a positive 492,862 units, which is such a precise and exact number that I'm sure that prediction is going to come true. Pinpoint accuracy aside, that number looks pretty good, like almost 500,000 compared to the negative 103,000 in 2022. It's not so much less than the huge 661,910 units absorbed in 2021. So I think that, yes, absorption is maybe a little less than it could be, but not in danger territory and certainly not negative like it was in 2022. Supplies, 780,000 units are expected to be completed, but Fannie Mae very much doubts that completions will be that high. They don't have a specific number, but even so, they do think that big supply increases are going to have an impact on a few key markets. Actually, I've been very curious to know how Sunbelt markets like Tampa, Austin, and Miami might fare in 2023. But unlike some of the other forecasts that expect solid rent growth in these markets, which do stand out by having strong job growth than other Sunbelt markets, Fannie Mae argues that the job growth in these markets is not strong enough to generate the amount of housing demand required to meet the increased supply that is going to be expected in 2023. So they, rather than like, I think Yardi Matrix, they predicted that specifically Austin and Miami are among the top. But according to Fannie Mae, they're particularly vulnerable. And so behind these projections for national and multifamily specific or market specific multifamily performance, sorry, that's a little bit of a word salad there. Behind all of their projections really is their economic outlook. That's the driver here. And I really think that that's the differentiator in a lot of these. If they think that there's going to be a huge recession, that's going to drive things down more than the fundamentals of the market themselves. According to their economic forecast then, total employment is expected to decrease by 1.4% by the end of the year. Unemployment is expected to increase from the current 3.5% to 5.4% by Q4 of this year. That's a big deal. And that increase naturally would have an effect on the multifamily market. But as we've kind of talked about when covering the GDP stuff, it's not set in stone.
Yeah.
And they also describe how the year might progress in terms of economic trends, and they say that while the year now appears to have ended on a stronger footing than previously anticipated, we, from Fannie Mae, continue to expect a modest recession to begin during the first half of the year, and are forecasting Q4 over Q4 GDP growth for 2023 to be negative 0.6%, a tick down from our previous forecast. They're on the darker, gloomier side of things.
Yeah. No, they certainly are, and I have some opinions about I guess. I don't know. Last year on their market outlook, I guess I didn't put as much weight on it. It was very all smart sounding, but for some reason I don't know. I don't put as much weight behind this report as compared to others.
Okay.
But I think it's obviously very important. And I think it all could be.
I like to read the ones that are a lot different, because this one is different and in a negative way.
Yeah, I know. I agree, and maybe I don't like it because it's a little more negative. But and this shouldn't matter. But there's kind of a. And I'm speaking anecdotally. I don't know like all the inside story, but there was a little bit of a cleaning of house or kind of an exodus from Fannie Mae and Freddie Mac in terms of top leadership and staff, because and this is a little bit of old news, because there were moves to privatize Fannie and Freddie, and under the Trump administration that didn't happen. Obviously Biden was elected, and that's not happening, and so all these folks were like in these jobs thinking that they were going to like take it private, and then everyone's like nope, and they're like, oh, so there's no opportunity here, I'm gone. So it was like a brain drain. Everyone left.
Yeah, brain drain.
And someone correct me and say that didn't happen, but that is what I have heard.
They feel bad, so now they're going to have a bummer of a forecast.
We're not going to have fun. No one's having fun. I have no reason to discount anything in this report.
My favorite.
It all looks great.
No, and there really is good information in the report, and I do definitely encourage people. You can disagree with their expectations,
I don't. I don't know.
I do like, my favorite part of the entire report was, so it's like I was thinking about how a lot of this hangs on the economic projections. The very last sentence of the report says, as their closing sentence, they say, it is important to note that whether the expected recession occurs early in the year or later, we expect the multifamily housing market to experience a softening in demand in 2023 and extending into 2024. So they're like, hey, Matt, I know you're going to think that this all hangs on the economy. This is still going to happen.
It's going to be softer no matter what.
Yeah, which I would continue to maybe discount it there, but
I don't know. Maybe they're right. There's certainly. I mean,
this is and the fact that this is this is a little bit softer. There are some that are going to be a little bit stronger. It's just a normal year, maybe.
Well, maybe we should have Kim Betancourt on and Tim Camoso.
I'll email these people. Don't think that I won't.
and if you're like, hey guys, no, this is the best report, this is why you guys are unintelligent, that'd be good feedback for us.
Hey, I'm willing to be wrong. That's how you learn.
Yeah, no, I agree. No, I take it all very seriously. I just they're just so far off some of the other kind of metrics that we're looking at and where things are going. Not like completely, but just like it's like they've like padded them down to be a little bit more conservative, where it's just I don't know, maybe a little too. Yeah, I don't know. So CoStar put something out nice a couple weeks ago. They put out so much stuff that's really good. Obviously, a lot of data coming in. And we can't cover all this, man. It's 93 pages, and you got to be somewhere soon.
They say global, which really means like Europe, South America, and Canada. That's the globe.
That's the globe. That's the globe.
It is another 93 pages. You say a lengthy report. I'm gonna really limit to their economic predictions and their multifamily commentary. So just to jump into this, the economy, in terms of recession risk now, and I remember this from last year. They have it broken down into like prediction number 3, prediction number 4,
of different base cases.
So by the end they get up a little.
Because in CoStar, and if CoStar is looking for CoStar is looking to sponsor any type of award-winning multifamily commercial real estate YouTube show podcast. I've got a recommendation because we use CoStar, and in CoStar you're in there. You can drop in the different economic scenarios.
Oh,
they're
nice.
forecasting. It'll show you the metrics, and then it has like forecasts for the next couple of years, and you can put in like base case. You can put in they change them sometimes.
Okay,
from different like Oxford Economics forecasts, and then like upside. So you can play around with some of these potential outcomes in the economy and see what the different capabilities
that's
may
nice.
or may not do.
I'll reach out to them too as well and see what's kind of possible. I know if we could play around with CoStar and kind of demonstrate.
We'll just take a couple, another free account to log. We'll just take one more login. That's all we need. We don't need the cash. We'll just take one or two more logins.
That's right. Yeah. I would.
It's like you don't have a login.
Yeah.
Addison needs a login, and we don't share logins. We don't.
That's why we want one.
We need more logins, and we'll keep. I was going to do a whole series, be like going on CoStar, looking at markets, and looking at properties, underwriting using CoStar.
Yeah.
But I don't know. I don't know if they'd want us to do it or not. But
I'd watch it. Okay. Yeah. So their economic expectations. They think that in terms of recession risk, a mild recession is expected with some additional downside risk tacked on because the Fed has indicated that they'd rather overdo it on the interest rate increases than give people a break this year.
Oh, they read our letter.
Yeah. CoStar also predicts declining consumer spending and kind of a reoriented job market, and it's pretty eye-opening actually, because right now there are about 1.67 job openings per unemployed worker. CoStar expects this number to fall under 1 by the end of the year, writing that the Fed has specifically cited job openings per unemployed worker as a concern for inflation. It's they're targeting it. They want to cause that pain. I'm not gonna. I had a whole thing written about how Jerome Powell's kind of like Thanos from the Marvel Cinematic Universe, but that's a little bit of fast. They're both looking for balance, really, and they both want to cause a little bit of pain, and then they'll relax after that.
Yeah, just a little bit of balance in the force. I mean, that's all. Well, I don't know. Anyway, go on.
Yeah. Okay. But the good news is that CoStar expects at least one rate cut this year. But again, not until we felt enough pain. But still, they expect a rate cut in. And a couple months ago, I was reading some of these projections. They weren't. So it seems like people are changing, or maybe they always thought this, but we could have an easier interest rate environment. So moving from the economy to capital markets, secondary markets are expected to attract more interest than primary markets. They're expecting cap rates to finally rise above BBBs, and they are expecting that distressed sales could increase a moderate amount. Nothing dramatic. I don't think that they really characterized it like that Globe Street article, which was predicting a flood. Maybe not the trickle that Marcus Julie predicted. Maybe more of like a stream. I don't know, a creek.
Yeah.
But they did note that possibility. They just didn't, they didn't place any level of importance on it.
Yeah, I do. I mean, we've been watching the triple Bs, the BBBs, which is like, corporate bond yields, and the fact that triple B corporate bonds tend to track and are much more correlated and similar to multifamily cap rates, because it is a better equivalent of perceived risk in the market. So a lot of people take a look at the 10-year Treasury and cap rate spread, and that is a useful metric. But I think the triple Bs are a little bit more important because that's where investors aren't typically going to say, I'm going to go into a 10-year Treasury or any Treasury bond or a multifamily apartment. But if someone is is focused on yield, you might look at a corporate bond that has a little bit more risk. It's going to give you a little bit more juice. And so you look at that and you'd say, okay, well, if the corporate's paying me 7, but the multifamily cap rate, which is not all encompassing on return. Cap rate doesn't equal return, but let's say it's relative for the sake of argument. Multifamily cap rates are 5, but the triple B's paying me 6. Okay, I'm going to go with the triple B. Yeah. Now, obviously, again, there's other reasons why you might go into apartments, but the risk premium is similar.
Yeah.
So anyway.
Yeah. So just diving in from capital markets and to multifamily specifically, they did try to distract readers by boasting that they accurately predicted 2022 rents falling to lower than half of 2021's numbers. They said, "Boy, did we nail that one," they wrote. But then again, I'm looking for them to nail this year, but I'll maybe I'm reading this
Is that
wrong.
true? They got the rent growth?
Not exactly, but yeah, they did. I think it was a little bit tongue in cheek.
Oh, okay. That's fine.
But anyways, we saw bigger, a more concrete prediction is that the square footage of new apartments is actually expected to be 5% smaller than pre-pandemic average, which is, I think, a really interesting prediction. Runs counter to the interest in larger apartment sizes that we saw throughout the pandemic.
That's true.
And I think that the fact that developers are not responding to this clear indication in renter is a clear renter preference. Developers aren't responding to it because of the slim margins and huge uncertainty that they're facing right now.
And you bring up a great point, Matt, is that it's like, yeah, okay, we've got a lot of units under construction, but like I think Carl Whitaker, I think, actually put a piece out today on LinkedIn or made a post on LinkedIn about this. It's all going into the urban core, but all the demands for the sub. Wow. So they're building small units in the urban core when all the demand is for large units in the suburbs.
Yeah.
So again, we're building housing, but we're building the wrong. Not that there's not demand downtown, but like
this is so. And there's actually was a comment on a video that we posted last week, and it said, this is the quote from the comment. It says, "As a developer, we're dealing with a three-headed monster." And this is a comment from Ryan Jones. I'm sorry, I'll make an edit there.
Yeah, Ryan Jones.
Yeah, actually, a comment from Ryan Jones this week said that as a developer, we're dealing with a three-headed monster. 1, costs to build are very high. 2, interest rate and cap rates are rising and narrowing our spread to less than 100 basis points. And 3, rents and demand are cooling. We don't want to take all the risk just to kiss our sister. Development just doesn't make sense right now. Don't disagree with that sentiment, really. Great Capital's acquisitions are focused on stabilized multifamily properties, but developers and their investors, at least from my perspective, operate on a higher level of risk. It's almost like we inherit the environment they create. They're the ones making that movement, and we're thinking, all right, where have they built and where have they not? They have to look 2, 3, 4, 5 years in the future to determine and maybe some of the places where they're building in these urban cores, they were under a different logic, and now that there's this suburban, they've got to react and do this again. So I do not envy their position, and I admire them, but it's a very risky endeavor.
Yeah, I mean, talk about a lot to predict. I mean, I was talking to a big developer yesterday, and he's like, lumber is still like expensive. Like it's cheaper than it was at the peak, but like prices are still tough. Like we're still having to get in line for supply. It's getting a little bit better, but it's not fixed, and it's still uncertain. And then you add not only interest rate uncertainty, which is getting a little bit better, but now it's the rent growth uncertainty. And I remember he said he's like, I just looked at a pro forma and for development pro forma, and they had 7.5% rent growth for years 1 and 2 of stabilization, which means they're going to deliver an apartment, Class A, at top of the market rents, and then they're going to get an additional 15% rent growth after that. And he was like, that's just not like that's insanity. Yeah. Like you deliver the apartment, you deliver it, and then you're supposed to plug in 3%.
Yeah.
Like not 7.5. You're not doing like what else are you gonna do? Well, if you can get that rent, why wouldn't you just lease it up at that rate? Unless you're like completely undercutting the rents at the beginning. So yeah, you can make anything look fancy and good on a spreadsheet, financial engineering, but like it's not reality. And it's you can see the opportunities for development, but that risk profile is hard to stomach right now for many, and then they're still building the wrong stuff.
Yeah, and that's one of the things that they actually comment about in, I think it's CoStar report, or maybe it was also the Fannie Mae, is that because of the interest rate situation and the risks that were so excellently described by Ryan Jones, there's going to be a fall off of constructions and starts.
And things are getting spread out. But I've seen some reports that starting in 2025, there's going to be a few fall off because there's so many projects that just like aren't going to be done right now, and people are doing other stuff, and there's going to be a gap. Yeah. And so it's like maybe we'll overbuild for 2 years, but then we underbuild for a few, and we still write a deficit. So we've got it's going to be a challenge.
Yeah, and I'm glad you have this market specific supply chart here pulled up because I think that apartment supply is going to be way different depending on where you're looking. The metric CoStar is using to estimate this apartment supply is inventory underway, which I'm guessing includes apartment developments that have begun construction, have not finished.
Yeah.
This a little less predictive than like expected completions, but it's a decent analog. I think the difference between some of these markets where they have a huge amount of supply coming on and some where they have a lower supply is enormous. You've got Nashville, Tennessee, which leads the nation with new apartment construction. They're almost going to add 15% to existing inventory. And Memphis, Tennessee, in the same state, is on the low end with apartment construction that would add only 2% to existing supply.
I heard a statistic that the new supply going to downtown Nashville is like, sorry, it's almost gonna like double the supply downtown.
Yeah. Wow.
It's a lot of new apartments downtown.
All downtown.
It's all downtown.
Yeah.
Again, downtown's a fun place to be. I don't know if there's that many people graduating college that are going to move in there. Because again, like the Gen Zs that are going to be graduating college, and they're the ones typically who are like, I'm getting a job, I'm going to move downtown, I'm on a big city living. Like there's not as many Gen Zers as there were millennials.
Yeah.
And so like there's not going to be as big of a push. The big demographic, the big chunk is the millennials, and they're all moving out to the suburbs or not necessarily downtown.
I wonder if the story about submarkets and in a general sense maybe start to get just as prominent as stories about like regions. For instance, one of the things that CoStar predicts is that rent growth in Sunbelt markets as a whole is going to be about half that of gateway markets. Gateway markets are
because they're going to be recovering, and
they're expected 3.5 for the gateways, and 1.7% average rent growth for the Sunbelt markets. And they specifically single out Nashville, like we've mentioned, and then Austin, Raleigh, and Charlotte as markets that are in a bad position to maintain caps at their current levels. Think that's going to be a really interesting to watch. We have seen this report that we were just finishing up on CoStar. Completely different take.
I was going to say
Yardi Matrix.
I was going to say I've heard completely different takes about some of those markets. Some people being like, "Oh no, it's fine. Austin is fine. Nashville is fine." Then people be like, "No, there's going to be pain." I don't.
Yardi Matrix had Charlotte and Austin as the 5th and 6th highest rent growth in the nation.
Yeah,
and so. We are really going to learn some things as this progresses.
So your point, earlier, it's so submarket. It's always so submarket and even neighborhood specific. And I wish there were more like, again, you can do this on CoStar. That'd be a couple new logins.
Yeah.
You can go into the submarkets. You can really rank submarkets and search different submarkets. I'd like to almost see top submarkets.
Yeah.
Now there's obviously tons of submarkets, but like I think it would be cool to do more of like deep dive into submarkets because that's really what you're investing in.
And we actually looked at a map a few weeks ago. It was like you hover over Phoenix, that's got one number, but Scottsdale's got a completely different number. So there are specific submarkets, but like I think sometimes the performance of a market as measured by some of these places is just like where they draw the lines.
Which Indianapolis, is it, are you just in Indianapolis? Are you talking about Indianapolis and you're just Marion County? You're talking about Indianapolis, Kokomo, Anderson, So, all right, Matt, great set of reports. You can find all these reports and more on greatreport.com. Sign up for the newsletter, greatcapitalllc.com/newsletter. Check out our latest offering for accredited investors. You can go to gray.fund or greatcapitalllc.com. Learn more about that. Make sure you're subscribed, leave a comment, like the video, and check out some of the latest interviews from some really smart economists covering the multifamily industry. Matt, thanks again. This was an awesome episode.
Thank you.
We'll see you next week.